Good afternoon, everyone. Hello, Create. Great to be here. For those of you that don't know Technomic, we are a restaurant and food industry research and consulting company. We've been around since 1966 and really track trends, consumer, operator. We've got a database of about 2,000 chains. And so what I want to talk to you about today are some of the things that we're seeing as we do research and as we're tracking the industry, looking not only at today, but then ahead, hopefully into the future in 2030. And so some of what I want to talk about, and I've got about 30 minutes, so I'm going to be speaking relatively fast, but I'm going to just give you some headlines, what we're seeing, and then really talk about traffic. Traffic is really the big issue that we see within the restaurant industry right now in terms of the challenges, in terms of what many of you restaurateurs are facing. I want to talk about that and give you a little bit of data. I want to talk about innovation and some of the things we're seeing happen on menus. I think for a conference like this, it's always important to talk about what makes a winner. And because we've been tracking chains, I look back, I think our first list was in 1970. And so we've got a pretty good handle on long-term data and who the winners and losers are. I want to talk a little bit about that and then finish with a future focus and outlook. So as we sit here in October of 2024 and I look at what's happening, and most of you can probably relate to this, we hear a lot about inflation, CPI. Certainly in the broader economy, things are starting to come down. We've seen some rate cuts starting to happen. Remains pretty elevated in the restaurant industry. We're still over 4% menu price inflation per the government. And what that means and what's happening then is these prices are impacting consumer behavior. We're really starting to see this slowdown in traffic. Traffic in both limited service and full service restaurants is actually now declining, particularly in limited service, which has always sort of been the haven for consumers in tough economic times. And then just as a result, flattening sales. And I will leave you with, at the end, some of the forecasts. You may be familiar, Technomic releases forecasts on the restaurant and broader food service industry about 3 times a year. I'll tell you where we see 2024 as well as 2025, and then even a little bit longer into 2028, 2029. So let me start first with consumer confidence, because I think this speaks to a lot of the heart of what's happening in the restaurant industry right now. September saw, at least per the conference board, a pretty significant drop in consumer confidence. You see it was 98.7, and kind of throughout the last year or two, it's sort of been trending in a fairly narrow range. So 98.7, you say, well, what does that mean to me? What am I supposed to do with that? I think it's really interesting to compare it back to previous full year averages for consumer confidence. And so you look back, 128, even during the pandemic year, the average was 101. It started to go up a little bit. But we are, by all accounts, at least per conference board, in a situation where consumers don't feel great about their own situation. Their confidence is down. Things are a bit challenged in terms of their own economic situation, in terms of their finances. And so then as you look at sort of what that means for the industry, and we've got a report, a tracking system called Tindex, the Technomic Index, where we look on a month-over-month basis what's happening to industry sales. And this is going back to 2022. We actually started it during the pandemic. But the index basically is indexing back to the same period in 2019. And so 113 that you see there means that the industry on a value basis is 13% higher than it was in August of 2019. And you just sort of see those growth trajectories, right? Recovery in 22, a little bit of a flattening in 2023, and then sort of late 23 and now into July, which is the last data point that we have, it's really been flat, right? And actually even going back into 2023, it's been flat. And really it's been around the 108, 110 mark since probably January of last year. So we've got much flatter growth now that the industry is fully recovered. And a lot of that is because, as I mentioned, consumers have been challenged by inflation. And so I think the important piece, too, is not just to look at inflation in a sort of a vacuum, but also to compare against some of the other things that consumers spend their food dollars on, primarily groceries, right? So FAH is food at home. This is the grocery inflation, CPI for groceries. You see that at 0.9%. It's come down quite a bit. Now, it doesn't mean that it's declining, but it's come down quite a bit, whereas food away from home, restaurant menu price inflation, as of the August number from the government, is still 4%. And so when you talk about this value equation that consumers are making on a regular basis, it is getting a lot more, I guess, economical to revert back to buying groceries and eating at home or packing your own lunch or doing whatever. And so this is certainly something that we're keeping an eye on because the food away from home inflation rate is a lot stickier than it has been in other parts of the economy and other parts even of the food industry, as you see by the grocery. And I think a reason for that is a lot of the other input prices, right? So food costs themselves have moderated, and I think this is an interesting chart, and actually I really love this chart. It only goes through June, I think, because some of the data points hadn't been updated from different government sources that we use. But there's a lot of sort of colors and charts on this, but what I really want to point out is this tracks on an aggregate basis 3 different things. And remember that inflation is not just a point in time. It aggregates and builds upon itself, right? And so what you have is menu prices, which are the green, which I talked about. That is now 28% higher today than it was in January of 2020. So when you talk about consumers and they're feeling that things are just really more expensive, they are. They're 28% more expensive. Well, what does that mean from the operator perspective? Why have they passed that on? Well, the food costs, and we look at a PPI number for finished food goods coming from the federal government. Food costs are up about 25%, and you see that's actually down a little bit from where it was late last year. But food costs are still up 25%. But I think the real kicker, and I know there's going to be a lot of discussion at this conference about it, are wages. Wages are up 32% in aggregate. If you just look at sort of that minimum wage and the BLS average sort of labor cost that they report for service and restaurant workers. And so this really is the new cost basis, right? This is, we talk a lot at Technomic about sort of a reality reset. And this is what the industry and I think consumers have to come to terms with, is that we are not going back to prices as we saw them in 2020 or 2019 or 2018. We are in a new reality, a reality reset where we all have to reset our expectations on what costs are, because this is where things are going to be going from here. And then it's not just obviously those prime costs, non-prime costs continue to proliferate as well, whether it's, and all of you, and this is an emerging chain conference, so I'm sure you're all building, doing construction, and you know, trying to recruit and train people, and you've got insurance costs and rent and repair and energy, and all of these things are continuing to go in one direction only. So it's not surprising that costs are up. And I think specifically to compliance, when we talk about compliance, we've got a new program called the Price Pulse, where we track on a quarterly basis different menu items across the country. And so this, I think, was just interesting. We don't have our third quarter data out yet, so this is still first versus second quarter. But I think it really speaks to compliance costs, right? We had the FAST Act that was passed in California. Minimum wage went up April 1st. And almost immediately what we saw is a huge spike in prices in California, right? So the national, this is just a QSR burger national price distribution. On average, $8.63. Second quarter, the average was $8.72. An average of about 1%, which if you think back to my inflation number that I showed you earlier, 4%, if you sort of annualize that, you get to about that 4%. In California, you had almost a 3% increase on average almost immediately, which means that if you sort of annualize that, you're getting close to 10 or maybe even 12%, whereas in places like Texas or New York, it was a little bit lower than that. And so I think that compliance piece is probably sometimes a little bit underappreciated, perhaps for some people out of the industry. I'm sure all of you in this room maybe appreciate it a little bit more than other people do. But I think it's really telling to look at what things like increases in minimum wage, and especially a huge jump in it like we saw in California at the beginning of the second quarter, and what that did immediately to prices. And so that's certainly having an impact. But if we sort of step back and talk about what's happening then in the industry, the trend in traffic, I think, is probably the biggest issue facing restaurants today, right? And I think most public chains that report would tell you the same thing. So we've got a program where we track consumers and we ask them about their visits, which is traffic. We ask them about how much they spent, which is check average. And then we ask them, basically and we aggregate total sales, right? So for limited service, what you see, and what we do is we kind of do a rolling 3-month average to get rid of some of the peaks and valleys on a month-over-month basis. And so things were looking pretty good for limited service throughout 2023. You saw generally about a little less than a 2% growth in traffic, and that's really what I want you to focus on, is that blue line. But really starting at about the new year, you saw a sudden dip, right? And as of March, April, we were slightly above 0, so things are still maybe positive. But really for the last 3 months, we've seen declining traffic in limited service. And limited service is both fast casual and QSR. And so if you think about what I talked about earlier with consumers and their confidence, normally limited service would be doing at least a little better as consumers maybe go to them. And you see how sort of check average has come down as that inflation number and as prices maybe have decelerated a little bit, and that sales number has come down as a result as well. But that blue line really is what's concerning to us, and it's something that we're seeing really across a number of different types of very strong concepts that would typically be better positioned in this type of environment. And so we see definitely a deceleration there. Full service looks even worse. And so I guess if you do put it on a comparative basis, you look at traffic really going back to May, and it's even earlier, but the chart only goes back to May. You see that full service system-wide traffic has been really down for well over a year, right? And it's probably closer to a year and a half, maybe even 2 years. And so full service has really been kind of propped up by those higher check averages, right? If you look at that red line, the check average, and then sort of the sales is kind of, sales in a very simplistic way adds traffic and check to get to the sales number. So sales have essentially been propped up if you're a full service restaurant in aggregate, and certainly there are some winners that are out there, but in aggregate as industry watchers, these are some pretty concerning numbers to us because we are in an environment and an economy where we've got full employment, where wages are generally good, maybe not quite keeping up with inflation in some cases, but the economy and the stock market's booming. And so when you see these numbers in a situation where we're not in a recession, it becomes very concerning to us. And I think part of it is, why is that? Well, 62% of people say that they're living paycheck to paycheck. And so when you say to yourself, well, how are we going to generate incremental sales? How are we going to get another visit out of people? How are we going to really get that traffic number up? It's very challenging when 62% of people are living paycheck to paycheck. And by the way, almost half of people with incomes over 100,000 say that they're living paycheck to paycheck. And these are prime restaurant goers, right? These are the people that I think a lot of restaurants really want to cater to. And so there's a lot of challenges, and I think a lot of it goes back to that price situation and the inflation, and people tend to spend to a certain amount, and they are spending that, but that traffic number is not, or is reflecting that because they're visiting less often. And in fact, if you ask consumers what your net expected changes, so we ask people, do you expect in the next, the next 6 months? Anyway, we ask them, do you expect to increase your visits to restaurants or decrease? And so we do a net, basically, right? The net is essentially people that say they're going to increase versus people that say they're going to decrease. And you see really throughout 2023 and into 2024 that number has been negative, meaning fewer consumers want or are expecting or are saying they're going to be visiting in the future than are now. And just for comparison, just so you know how to get the math, about 23% in the third quarter said that they expect an increase, 36% say they expect a decrease, which leads to that minus 13 points there. And so that's a concerning number to us. We're really looking at that. And again, you ask them why, and it's prices. Prices are too high. My budget for ordering food service has decreased. There's not enough deals. You may get a couple people saying gas prices. Gas prices aren't particularly high historically, but when everything else is going up and you still got to fill the tank, that does become an issue. And delivery fees are something that we hear as well for people that aren't ordering as much delivery. But if you look at really those top two, it's all about prices and budget and deals and the inability for consumers to feel like they are able to afford a restaurant meal. So what does that mean when you've got higher prices and declining traffic? You see deals, right? And this is really where we're at now in October, and even going back to the summer. And this is just an example of some of the headlines that we saw over the summer. Some of them from my colleagues on the media side here. But the value wars have really erupted, not only in QSR, where McDonald's, Starbucks, a number of different chains are doing different promotions and that type of thing, but even on the full service side, right? All you can eat wings, and Chili's, which has had tremendous success with some of the deals and targeting the QSR consumer for a better value by going to Chili's. You see these value wars erupt, and so there's some surprising names on the list. And I think that deal and that value really is probably not going to end anytime soon, given some of those numbers that I just showed you. So what do you do if you're a restaurant? How do you then excite your consumers, or how do you get them to come? Well, the innovation piece, I think, is important. And so when we track, and we've got a menu database of tens of thousands of items and different locations, and so we'll be talking a little bit more about this, by the way, on Friday when my colleague Robert and I are doing a little bit of a session with some of the operators in the audience here. But LTOs, right? Not only on a year-over-year basis, but also on a 5-year basis, limited time offers have skyrocketed. Restaurants are trying to appeal to consumers and get them excited by bringing out LTOs. The core menu, those things that are on the menu, actually we've seen a little bit of bump year over year, but it's still down over 4% compared to where it was 5 years ago. And so the menu and what's happening on the menu is there's a lot of innovation, there's a lot of trial and error going on, and it's typically all happening on the LTO side, where we've seen huge increases in the number and type of LTOs that we're seeing. I also think, and I run our Beverage Insights program at Technomic, and I do increasingly believe that beverage is one of the battlefields for restaurant innovation right now, right? And if you just look at some of the things that not only established chains like McDonald's are doing with their Cosmics, which, you know, really in a way is a beverage-forward drive-through concept intended to perhaps, you know, get some learnings for the broader McDonald's, but also I think they looked at some of these other success stories, right? Whether it's Swig, HTO, whether it's 7 Brew Coffee, all of these are getting double-digit sales growth, securing investors, mapping out very aggressive unit growth items, and all of them are beverage forward. And so we've seen a lot of innovation, a lot of things happening on beverage, and I do think that that's really becoming the innovation battlefield for a lot of restaurants right now. The other type of innovation we're seeing is investment in tech, and we heard Juan just talk a little bit about tech. We did some research with limited service customers, and you know, again, when you talk about some of these tech-driven amenities, whether it's payment, whether it's ordering, whether it's, you know, drive-through type things, it could encourage about 25% of consumers to visit if you had those. Now, it's a little bit smaller on the full-service side, but tech investment is really something, not only is it helping your efficiencies and really helping drive a lot of the things that you as restaurateurs want to do, but it is something that consumers are increasingly looking for as an enhancement to the experience, by the way. I don't want to just say technology for technology's sake, but it really does have to enhance the overall experience. And I think when you talk to consumers about their expectation of digital amenities, right, whether it's mobile ordering, whether it's online ordering, whether it's in-store kiosks, mobile ordering with GPS, these are all things that we asked about in our recent research. You know, you see somewhere between a third to maybe, you know, not quite half of consumers that say that that is an expectation. That is a table stakes for when they go to a limited service fast food restaurant. And then from a payment perspective, it's maybe a little bit lower, but still pay via digital formats, via mobile app, QR codes. QR codes are still around. Digital currency, there's some expectation there. And in all of these instances, by the way, there's a small, maybe 8 to 10% of consumers that say that if it's not there, they will likely go elsewhere. So not only are you encouraging consumers by having these, but if you don't have them, there is a small but pretty significant portion of consumers that may go elsewhere. So I think a conference like this, I wanted to throw a couple of slides in on this, and this is, again, is something we're going to talk about a little bit more on Friday. But with a conference like this, it's important to step back and ask, what does a winner look like, right? How do we maximize our chances of success? And so I want to give an example here of something that we've looked at a couple times, because at Technomic, we get asked a lot, mostly by suppliers, how do we identify the next Chipotle? Everyone's looking, suppliers, everybody wants to jump on the bandwagon for the next Chipotle. And there's thousands and thousands of emerging chains, and like I said, we're tracking about 2,000 of them, I think even a little bit more now. So one of the things that's important is to highlight those with the biggest likelihood of success. And so I think a great example is this, right? And if you step back to 2002, I went back about 20 years, and it wasn't clear back in 2002 that Chipotle would be the next Chipotle, right? If you look and you compared Baja Fresh and Chipotle, they were pretty similar in terms of total revenue. They were pretty similar in terms of US locations. Their average unit volumes were actually pretty close. You might even give a little bit of an edge to Baja Fresh. And so if you look back at that and you said, all right, I'm sitting as an investor in 2002, which one am I going to bet on? We all probably have the hindsight of, of the last 20 years unfold, but if you look at where they are today, it's just a jarring contrast, right? Chipotle is now the 9th largest chain in the US, $9.8 billion. This is as of 2023. Almost 3,400 locations, average unit volumes of $3 million. Baja Fresh is still around. It's number 466 on our top 500 list, but it's actually $185 million smaller than it was almost 20 years ago. And so I think those types of things make certainly our suppliers and even restaurateurs step back and say, well, what are really the keys to help make sure that we could be the next Chipotle and not necessarily the next Baja Fresh? Well, we've gone back and looked, and this is kind of a laundry list of commonalities of success. But I think when you talk about positioning and execution, there are some things that we notice from chains that have long-standing success, that have sustained models of excellence. Consumer appeal, and we heard a little bit about that earlier, and the defined menu category. And so there's that piece as an investor. You want to be a fan, as Candace was talking about. But regional excellence, doing really well in a region before starting to expand. You've got to be differentiated. You've got to offer a contemporary experience. You've got to be tech forward. These are all sort of positionings. And again, as we move into the 2020s, that might be different than it was 20 years ago. But I think it's mostly around execution. Unit economics, I think, are one of the biggest indicators. Demonstrated growth. You've got an off-premise focus, particularly where we are today with on versus off-premise. You've got experienced leadership at the helm. You've got a strong franchise strategy, deep pockets. And conversely, if you look at then what are signs that a concept may not have a sustainable outlook, I think that franchisee piece is pretty critical, right? Rapid expansion, poor vetting of franchisees. We've seen a lot of chains that have just added too many too quickly. Geographic promiscuity, as I call it, which just basically means you're expanding too fast and you're expanding beyond the reach of being able to build a sort of a nucleus in particular markets. I think we would look at culture, and so if you've got excessive turnover happening, whether it's at headquarters or at the unit, excessive franchise fees, uneven product specs, if people aren't getting the same thing from location to location, that's an issue, and then if somebody's really heavily discounting. So we're going to talk a little bit more about this on Friday morning with some of our chain operators, and really I think being able to build a differentiated strategy and figure out how to address some of these and how to avoid being that Baja Fresh as an example and being more the Chipotle is really I think why we're all here at this conference. So just a couple of minutes on future focus and outlook. As we sit here in October, what have we seen over the past month or two as we're in the second half of 2024? Relentless value emphasis, and quite frankly, value where value equals price. Now we know that value is a lot more than just price, but I think what we've seen by a lot of chains has been an emphasis on that price side. The result has been a little bit of stabilization, although the numbers I showed you weren't great, right? And so the question is, where does it end? And I think that's an open question. But the good news is, if you look at our current forecast for the industry, and again, we revise every 4 or 5 months, so we had a forecast in May, and now we just put one out in September. We actually bumped up our limited service forecast. We believe limited service will grow about 5.2% now, bumped it up a little bit. Full service, we actually bumped up a little bit. Before you say, well, that's, things are maybe better than you thought, our inflation assumption is higher. So we were thinking that inflation would be dropped into the 3s, 3.5s maybe. So a lot of that is driven by a higher inflation assumption, which again, as we saw in that previous chart, means that traffic is probably still going to be flat Certainly for full service, if you subtract that CPI out from full service, you're going to continue to see negative numbers. Limited service may eke out a little bit of a gain, driven largely by fast casual. For 2025, as we look ahead to the next year, we see about a 5.3% growth in limited service and about a 4.5% growth in full service. Again, our CPI, that's the menu price inflation that goes into our expectations, is actually almost a point lower. So that means that we do expect to see a little bit of positive incremental traffic happening next year. But I think importantly, if you look at, and one of my colleagues said, don't put this up because you're going to depress all the full service restaurants in the audience. But I think when you look at what's happened over the last 20, let's call it 15 years at least, limited service has been the growth engine for restaurants. Not that there's necessarily no place for full service, but if you look at back in 2008, limited service, quick service and fast casual made up about 52% of total restaurant sales. Last year, that was about 63%. So you've got this huge increase, and then as you look ahead, and we do long-term forecasts for our clients, that'll probably grow another 1.5 points or so to be about 64%. So not the future and where a lot of the growth is happening is in that fast casual area, and even in QSR. And full service really has to fight for that differentiation. It really has to fight to create that value proposition for consumers. So just to wrap up, and I think I'm hopefully mostly on time, but just as I sort of assess the state of the industry and where we're at today, even with strong employment, even with good numbers, with a strong economy, industry traffic and growth is flat. And so I think our sense is growth will start to happen again once consumer incomes start to catch up with some of these higher prices, because price has gotten beyond the affordability threshold for many. Heavy dealing's becoming the norm, which, as we know, is not sustainable. I've been doing this 28 years at Technomic, and I've said publicly a number of times that I think it's harder than ever to profitably run a restaurant in today's environment. And so that dealing certainly is intended to drive that traffic, but it's certainly not helping the margin or profitability. And so this year we do think there's going to be some growth, but we're a little bit more bullish and optimistic. Not much better, but we do think there will be better conditions expected for 2025. So with that, I am out of time. Thank you all, and I'm going to bring up Alicia.